Welcome everyone to the Daniel Krug and Associates Wealth Management Review for November 17th, 2022. Today's presentation is titled Midterm Election Surprise and Investment Update. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me in this presentation. Just a reminder, this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have any questions, please call the office and we will help you work out your question. Before we get to the agenda, let's do a little housekeeping. We're looking at about 20 to 30 minutes today. The session will be recorded for a future playback. Everyone on the call will be muted, so if you have a question, please use the chat room and we will follow up with you. We also want to thank CNR for their contributions in the research and the presentation. Today's agenda, we're going to go over the economy, a brief overview. We're going to talk about investing and staying focused. We're going to then go into a portfolio update and conclude with some closing comments.
Okay, so we got a little bit to go over today. We're going to really talk more about, where are we with the investments and, the market, midterms, things like that. Yeah. But we'll just dive right into it. So I'm going to talk first about the economic indicators. Okay. And if most of you know, but I'm going to go over this anyway for those that are new to this, we use City National Rockdale's economic and financial indicators to really get an understanding of where the markets and the economy is going. And the economic indicators are really forward-looking 6 to 9 months. And the way these dials work is you've got yellow, which is neutral, you got red, which is bad, and then you got green, which is good. So when you're looking at these dials here, each dial has 1 or 2 dial hands on it. The gray dial basically says, where was it last month? And the black dial is, where is it today? So if you see both a gray and a black, you know that there's been movement in that specific area. We're looking at October right now because we'd like to look to see what was going on in October and then see where we are today. So October, we ultimately had really 6 different indicators that went even further negative. 2 of them actually went into the red. So it was showing that the market is still in a correction, market and the overall economy. Now let's fast forward to November. Well, in November you can see that none of the dials have changed. So there is a little bit of a standstill, which is potentially a good thing. Now it's only 1 month, so we really do have to take a look at what happens in the upcoming months to determine, is this a true lull? Did we hit the bottom? Are we just at a point where we're about to turn around in the economy? We'll have to wait on this, Rocky, and see where we go from there.
Yeah, it is interesting. We are seeing a little bit of maybe a slowdown,
Yeah.
in the wrong direction. Everything was moving negative, and that is slowed down a little bit in November. That could be a good sign long term. Again, we want to see this for 2 or 3 months.
Yeah.
That it's not everything moving to the red, that we actually are starting to see some economic light at the end of the tunnel for the middle to end of next year. And I think we're kind of starting to see that.
Well, I hope so. The only thing that's kind of worrisome right now is you have companies like Microsoft, or not Microsoft, it's Facebook and Amazon, both of them really laying off or projected to lay off double-digit.
Yeah, there's some pretty big layoffs coming in the tech companies.
Yeah, there are. I mean, 11, 13,000, that's not small numbers, and that's just 2 companies. So right. It's likely that the labor part's not going to look as good next month. And that's a big driver because that deals with consumer sentiment and the spending.
Yep.
So we'll have
And
to.
the wages keep
Yeah.
going up as long as, the labor shortage is there. So
Yes, yes.
that's what the Fed's trying to get control of. So
Yeah,
why
we'll
don't
see
we-
how it works.
why don't we move on a little bit, talk about investing and staying focused. So just for a reminder for us as investors out there, markets are volatile. This is nothing new. This has not been a good year, and we'll talk a little bit more about that in a second. But volatility is not new. It's going to continue on, and we don't see that changing a whole lot going into the end of the year and maybe into the first quarter of next year. Market sector and asset class performance also constantly changes and is not an indicator of future performance. We saw that in the COVID era, when we were right in the middle of it and things were shutting down, people were being told to stay home, not go out. It was the tech companies that really propelled the stock market out of a recessionary period there that we saw in that second quarter of 2019. So if you look and fast forward to today, those same companies are the ones we're talking about laying off.
Yeah.
So that's a big problem, and they also have had huge drops in their value of their securities. And so, those were the big losers in 2022. We do not chase sector or asset class performance. We use diversification, and as it says here, it's time in the market, not timing the market, along with proper portfolio diversification and rebalancing that greatly improves your chances for growing wealth. Now, one of the things I just touched on just a minute ago is generally in the past, U.S. stocks and bonds don't move in tandem. This chart says rarely move in tandem, and that's true. When you look at this, the dark blue bars represent the S&P 500, and the light blue represents the U.S. Aggregate Bond Index all the way back to 1997. You can see there was very little correlation in the movement. When stocks were doing really well, bonds were doing okay, but not great. When the stocks were down, the bonds tended to be up in the past. Go all the way to the right side of this chart and you can see the type of year we've been having. We've actually had the rare movement of stocks and bonds going down double digit at the same time in the same year. So that's kind of forced us into changing kind of the strategy, Dan, of working with portfolios where we're using cash as an asset class,
Right.
because you can't switch over to bonds and try to stabilize the portfolio and give some kind of return. And we'll go into a little bit more detail in our portfolio update on the stock and bond picture for the future. Also, this chart, this is really important for us as investors to understand that market cycles and economic cycles are not in tandem. They do not move exactly with each other. As you can see in the dark blue line here, this is a chart of the market cycles, the going up, the growth in the market, and then the tailing off and the reduction in the market, and then recovery again in the future. And when you look at this over periods of months, we tend to see the lighter blue or green line, it might be green on your screen, is a economic cycle. And those cycles tend to peak months after the market has already peaked and started to go down. We're in this beginning of this market decline. Again, what we have to be mindful of moving forward is that the market, you look at the right side of this chart, the market tends to recover much faster than the economy. In fact, historically, it's several months before you'll see the market start to recover and the economy is still going down. From an intuitive standpoint, that doesn't make sense, but that's why we talk about you have to stay invested, because this market will start to recover way before the economy does. And this is the picture we think of next year, that we're going to actually see the market start to recover while the economy still is slowing down.
Yeah, you won't feel the recovery in many cases. And this is where when you're looking at the economic indicators and you look at this graph here, the economic indicators are looking 6 to 9 months ahead.
Yep.
So on a cycle peak of the economic cycle, and you're looking at it against the market's gonna peak before, or it's gonna actually hit the bottom before and take off before the economic cycle does. So that's one of the major reasons we're looking at all the economic and financial indicators, because they're going to help signal when we're actually at the bottom. Now, again, there's no timing the bottom, right? It's going to come. It's a fool's errand.
It's a relative. Yeah.
So the key, like Rocky said, is to stay invested. And one of the things that we were talking about, you were mentioning it on the slide that showed the S&P 500 and the bonds, is, man, I'd love to be back in 2001. 2000, 2001, 2002. Most people would say, oh, I don't like that at all. The stock market was down 53%, but the bond market was up. And at that point, we were primarily in bond-type programs for that time period, and our clients didn't lose any money. So it was a whole different situation, a little bit more predictable, because the bonds were actually running in a normal bounce back, I guess you might say. So let's go ahead and move forward, and let's talk a little bit about the portfolio strategy update. So what have we done so far, and what will we be doing? Well, when you talk about that, you've also got to think about the fundamentals relative to political control. Now, why do I say that? Well, because over the last 30 days, everybody was believing that we were going to have a red wave. And as it turned out, it was barely a ripple. Now, how does that play into whether the market is still going to go up after a midterm? That's the interesting part, because when you look at the market after a midterm election, it almost always moves upward, and it usually moves upward in a significant way. Does it mean that the economic cycle is turning around right now? Not necessarily, because I think we have some other things that have to shake out before we get to that point. But the markets did do what they normally do after a midterm election, and that is move upward. So when you're looking at this chart, fundamentals matter more than the political control. So when you're looking at the way this chart is structured, on the left-hand side, you've got rates of return, and on the lower axis, you have a bunch of letters and numbers, right? What do they represent? It represents the political parties who are in control. It's the presidency, the Senate, and the House. If there's a D in front of the number, like the first one there on the lower left-hand side, DDD, what did that mean? It means that the Democrats were in control of the presidency, the Senate, and the House 22 years. Now, that's not 22 years in a row. That's just 22 years that they were in control of all three of the governmental bodies. You go to the next one, which is DRR. That's Democrat president, Republican Senate, and a Republican House. That was for about 11 years. Now, how does that correlate with how the returns were in the market during the times that those parties were actually in power? Well, that's where you look at the green bar. So the first green bar on the left is 10.3%. So while Democrats had full control within those 22 different years, the average rate of return was 10.3%. And then when the Republicans and the Democrats were in other words, a Democrat in the presidency, Republicans in the Senate and the House, it was up 14.6%. Then you look at the third bar there, you had Democrat, Democrat, and Republican, and it was up 16.8%. And really, it kind of goes through this whole process. What it tells you is it's not so much the political control as it is the fundamentals of the market. Again, we're not trying to get out because one party's in or another party's in, but when it comes to the midterms, we do have to be mindful of historical data, and that is that it rises after a midterm because what happens? There's certainty now. People know who's going to be in control and they have an idea of the direction that they're going to go. And one thing the market likes, Rocky, is certainty. Doesn't like uncertainty. So before the election, you saw a lot of volatility. After the election, you're seeing a rise up in the markets. That brings us to where are we with our portfolio strategies relative to the stock market? And when I say stock market, I'm really looking at the S&P 500. That's the main focus we look at because it's large cap stocks, 500 of them. It's not the Dow where you get the 30 top stocks. It's a much broader index. This chart shows how we've been in a roller coaster ride since the beginning of the year, you know, up and down, up and down, up and down, all the way in a lower downward bias. So when we got to a certain point in the stock market, we started moving to cash again because there wasn't any other place to go at the time. Bonds weren't really an option. So we increased the positions in our cash, and we did that twice. We did about 10% relative to the higher risk portfolios, and then the second time, another 15% in all portfolios. We were looking at when do we get back in, and it was really relative to whether we hit the bottom in the stock market or are we bumping up against the midterms. We don't believe we've hit the bottom yet. We think that there's still some room for it to drop, but we did run up against midterms. So what did we do? We went all back into the portfolios on the 4th and the 7th of this month before the elections. And as you can see, right around when we went in after the elections had come to pass, you saw the market rising back up again. This chart takes you to Tuesday, I believe. We still have some more strategies in our quiver because at the end of the day, we don't think this volatility is over. And to give you an idea, let's go back to this chart, which talks about the S&P 500 valuations. And the chart specifically is the S&P 500 forward price in earnings ratio. If you're in the red, basically that means the overall S&P is overvalued. Yellow, kind of fairly valued. Blue, it's attractive. Green, very attractive. And if you think about the big money in the stock market, they're really looking for an attractive or very attractive entry point into the market. And we're just not there yet. So this is one of the things that we're looking at, which leads us to believe that it's not time. We haven't hit the bottom yet, and the overall market isn't ready to jump all back in again. Now, let's look specifically to the actions that we've taken so far and what we could possibly be doing in the future. So from an equity side, we've increased the equity position in all the portfolios. We've reduced emerging markets Asia to a minimum exposure. We've got a minimum exposure in Europe, and we are focusing on quality defensive blue chips in the portfolios. From a fixed income standpoint, many of the portfolios have increased to investment grade bonds, and they've changed the duration, the sectors, some exposure, security selection relative to fixed income. On the cash bond side, bond alternative, we've reduced our cash positions in the portfolios back to normal, which is around 2 to 3%. And keep in mind, we're always taking into consideration each client's current life cash value and fixed income annuities that we have. So they become that bond alternative. What are the potential actions in the future? And this really comes down to what is the market doing? What are the economic indicators telling us? Some of the options that we have is we could again reduce equity positions in the portfolios by 10 to 15%. We can reduce EM, emerging market Asia, to zero. That might end up happening. You know, when you're talking about value stocks and growth stocks. Right now, we're pretty heavily in value stocks. But if we do hit that turnaround, the growth stocks are going to be performing better. So we'll be watching that. The other option here is we could be adding a gold silver to the portfolio as a bit of a hedge. Going again to fixed income, we could be adding a laddered treasury portfolio. This would be a short-term portfolio, 1 to 1.5 years. We could also change the duration and the sector exposure again relative to the fixed income. So we're kind of keeping an eye on the different sectors, asset classes, to see which ones are really working themselves into that mode of moving forward. And then again, from a cash bond alternative standpoint, we could certainly be looking at increasing cash positions down the road again. However, I don't think it's going to be anywhere near as what we did earlier this year. Now we're getting to some closing comments here. So Rocky, what are your thoughts on that?
It's interesting. No, you know, when I think back of what happened in 2008, you talked earlier about 2000 and 2002. In 2008, we had a financial crisis along with an economic crisis and a market crash. So one of the things we did, and the reason you had gold and silver as a potential out there, is that we did hedge the portfolios back then with some gold and silver, and it really paid off. I mean, gold back then went from 600, 700 an ounce range to 12 to 14 over a couple years there with the financial crisis. And that's a potential, not financial crisis necessarily in the future, but the reason that gold and silver are actually down year to date with everything else is because rising interest rates. As long as the Fed keeps raising interest rates, the value of the dollar is going up. The minute that stops, I think you're going to see a reversal in a lot of things because the value of the dollar will start to come back and normalize, which will bring other assets like that into play. So it's something that we're watching out there and looking for the right time to hedge the portfolio again, should that situation start to occur. So,
well, how much does the situation where Russia and some other countries going back to the gold standards, how do you think that's going to affect us in the future?
I think that's why they're doing it too, is everybody's kind of hedging, you know, on what's going on with fiat currencies around the around the world. You know, the printing of money and stuff like that should be devaluing it, but because they're raising the interest rates, they're propping it up. So we'll see. We'll see. But yeah, countries are hedging too.
Well, that's interesting. Now, we still got some problems ahead though still, right? I mean, you've got the Fed that's got to unravel that balance sheet, and that's a huge balance sheet right now. We've got our national debt that's just out of control. If we don't stop spending money, I don't know how we're ever going to correct this thing.
Yeah, and the cost of the debt is going up with rising interest rates. So
well,
that's why
that's probably a big danger right there, right? If the interest rate goes up, what, 3%? What does that do to that debt load we have?
Right.
Wow. So you think your mortgages can be high with the new interest rates? Imagine what's going to happen with a $32 trillion debt and 3% more interest on it.
Yeah, the cost of the servicing the debt is going up every month.
Wow, I think I heard that around $1 trillion at 3%, we'd be at around $1 trillion at 3% increase on the interest relative to the debt load. So that's, quite frankly, not sustainable.
Right. That's why these interest rates can't go on too much longer. I think it's going to...
Well, they got to get it under control, don't they?
Yep.
If you can't control one thing, control the other.
Yep.
Well, that's interesting. Any last thoughts?
No, I think we're watching and keeping a pulse on things. So, and you can see that we are nimble. We're not just setting it and forgetting it. We're watching it. We're making adjustments. We raised cash. We went back in the market. We'll raise cash again. So we're actively managing through what's going on in the economy and in the world. So.
Yeah, it's a different time than it was 5 years ago or 10 years ago. It just, you're having to really work the market a little bit differently, more active than certainly we want, but it's what it calls for right now.
Yep.
Okay, well, let's go on then. We're a full wealth management firm. And as that, the investment consulting is really the driver of it's like the fuel in the tank to keep us moving here. And that allows us to do the wealth enhancement, the wealth transfers. It allows us to get into wealth protection to make sure your estates and everything's all buttoned up and you're protected properly. And it also gives us the ability to enhance the charitable giving that our clients like to do. So it's that piece right there, that with our strategic partners, that allows us to go the extra mile for our clients that most firms, quite frankly, don't do. If you're watching this and you've really never experienced Daniel Krug and Associates, good time to come in and kind of kick the tires and see exactly how we can help you increase your wealth. Let's go on to the YouTube channel. If you do want to hear more information, you can go straight to the YouTube channel at Daniel Krug and Associates YouTube, or you can go to mydkna.com, click on Watch Us tab, then DKNA YouTube, and it'll bring you directly to our YouTube site. And you can watch the full replay of any of the webinars that we have, or we have 3 to 5 minute snackables that you can kind of jump on, hit one subject, and then get right back off again. It's always there and it's always moving. That brings us to the end, Rockies. Really, there's no need to worry. You take care of your family and
we'll take care of you. We're 1 week away from Thanksgiving. We want to wish everybody a happy Thanksgiving.
Absolutely.
And you focus on your family and this family time of being together, and we will be focused on the portfolio.
Amen. Goodbye.
Have a great day.